Have you ever received a tax notice from the ATO that you weren't expecting, even though you're already paying a high amount of tax? If you're a high-income earner, there's a specific rule that could apply to you, and many people don't even realize it exists until they receive that letter. It's called Division 293 tax. And today, we're going to break it down in a simple way so you understand what it is, who it affects, and why proper planning is so important. So, what exactly is Division 293? In Australia, concessional super contributions, like employer contributions or salary sacrifice, are generally taxed at 15%. But once your income goes above $250,000, those same contributions may be taxed at 30% instead. That's an additional 15% tax. Now, this rule was introduced to reduce the tax advantage for high-income earners, but the challenge is, a lot of people aren't aware when it actually applies to them. So who does this affect? Division 293 applies when your total income, plus your concessional super contributions, goes above $250,000 in a financial year. And it's important to understand, this isn't just your salary. It can include your wages, bonuses, investment income, and even certain reportable benefits. So sometimes people think they're under the threshold, but once everything is added together, they've actually gone over. We commonly see this affecting professionals, business owners, executives, and individuals with multiple income streams. Now here's where most people get caught off guard. Division 293 isn't calculated immediately. The ATO calculates it after the financial year ends, once all your income information has been finalized. So what happens is, you go through the year thinking everything is fine, and then months later you receive a notice from the ATO. And for many people, that's the first time they even hear about Division 293. That's why it often feels like a surprise, because it's not something you actively see during the year. This is exactly why tax planning becomes so important, especially for high-income earners, because when you understand your position early, you can start making better decisions around your finances. For example, how much you contribute into super when you receive income, and how your overall structure is set up. Without proper planning, you could end up paying more tax than expected and reducing the overall efficiency of your super strategy. But with the right advice, you can manage your exposure and align everything with your long-term goals. Let's make this simple. Let's say your income is close to $250,000 and your super contributions push you over that threshold. That extra portion may now be taxed at 30% instead of 15%. Now, it doesn't mean you've done anything wrong. It just means you've crossed into a different tax treatment. And if you're not aware of it, that's where the surprise usually happens. So, Division 293 isn't necessarily something to avoid, but it is something you need to understand, because the more informed you are, the better decisions you can make around your tax and your super. At Reyes Group Australia, we help high-income earners understand their position and build strategies that are efficient and aligned with their goals. If you're unsure whether this applies to you, it's always worth having a conversation and getting clarity early.